Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Mitri Programmatic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor. Call your broker. That's what they're there for, to help you with advice, provide you with guidance. There's the disclaimer.
All right. A couple housekeeping notes before we get started. We have your monthly webinar series with Interactive Broker tomorrow.
Yep.
I'll put that link in the chat. And also there was, you mentioned, I forgot about it, but did go and get the link on the email. Jake sent us a new article he did, and it's posted in Seeking Alpha. I'll also put that in the chat.
Okay. Yeah, perfect. Yeah, Jake, one of our longer term customers, did write an article on Seeking Alpha, sharing how to use some of the tools to trade around earnings, mention it to us. So I think it's worth a read. We'll put that in there. And tomorrow's webinar, it is with Interactive Brokers. So you do have to register with Interactive Brokers. They're hosting it. It doesn't go on YouTube. So, once you register, they'll send you a reminder. You could log in. And then I think afterwards they do archive it, the webinars on their website. But it's not going to get posted like these that we do every morning on YouTube. And if you're joining us for the first time with this show, Will and I, we do this show in the mornings to help answer questions you may have about the Market Chameleon tools, data, analytics. If you would like to ask a question and you want to come on a show and ask it, we do provide a link to Zoom. It's in that live chat. Click on that link. When you come over to Zoom, on the bottom of the screen, you'll see a button, raise your hand. Click on that. You don't have to turn on your video camera. It'll ask you if you want to turn on your video camera or not. You could say no to that. Once you come in, you could ask your question live, direct, navigate us to maybe something that you're looking at. If you prefer to type in your question, you could also do that. Type it in, put it on that live chat on YouTube. Will's watching it. He'll read back the questions. And we're going to give a couple minutes for more people to join and put those questions in. So what we'll do in the meantime is start out taking a look at the pre-market report, which are stocks trading in the pre-market hours. We'll take a look at the report, see if we could get some insights from there. Okay.
Perfect.
Pre-market report. These are stocks that are actively trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, and I see 43 stocks made our percentage gainers list, 65 on the decliners. So right now, from this perspective, looks like a bearish bias at the open. But if you take a look at this list, you'll see that there are stocks in there that are low cap stocks, ETFs, leverage products, it could be preferred stock, anything that's listed on a major U.S. exchange. If it's trading in pre-market hours and it meets our thresholds, it can make this list. And what we want to do is filter down this list of stocks so we could narrow it down to a smaller group, maybe get a little bit more focused insights. And to do that, we could use the filters here above. And I'm going to use this filter in ETF. If you click on it, you see a list, a drop-down list with different ETFs in there. Some of them are sector ETFs. The top three are more broad-based ETFs. SPY, that's S&P 500 ETF, this one up top. Let's click on that. And the list below will get filtered by stocks that are holdings in the SPY ETF, and which are the S&P 500 constituents. And here we do see 7 stocks made our percentage gainers list, 14 on the decliners. So again, from this perspective, looks like we're setting up for a bearish bias at the open. And we do have, I think, earnings kicking off this week with some of the big bank stocks.
Yeah, I'm pretty sure the banks are on Thursday. And that's usually when they start. I mean, listen, they're earnings that are happening all the time, right? But usually when they refer to earnings season, when the majority of stocks start reporting, usually starts with the bank, when the banks start announces. Yeah.
That kind of like if we wanted to benchmark the start of it, usually like the big banks would start it off. We hear from them, then that kind of sets it off. And there is a lot of news right now out around that banking sector. We'll hear from their perspective.
It'll be interesting to see those risk disclosures in their reports, right? That you've talked about.
Yeah, the risk disclosures, and going forward, most likely we're going to see new rules, regulations, new formulas for monitoring bank risk. And it's not really clear right now, how that will change, our financial system, our financial structure. Is it going to make borrowing harder? Is it going to tighten up credit? What are the banks? But, with the SVB, where they were invested in the long-term treasuries, but they weren't actually invested in a risky asset. They just had, duration risk. That's what so it's not the risky asset. It was just, every, security has some risk, right? So they had exposure to interest rate risk, right? It wasn't default risk. It was interest rate risk. And they invested heavily into treasuries when interest rates were super low. And they were wrong in their model or their forecast of where interest rates could go moving forward. And that's really where they erred. And top of that, I think that they erred in how stable their deposits were, right? That the deposits that they were carrying, they weren't stable, right? People were drawing them or taking them out consistently, especially when economic times were harder.
Yeah, and people are chasing yields too, right? A lot of banks aren't paying for holding deposits, right? And you can put it in a money market or at a brokerage firm, or just set up a Treasury Direct account. And
this is an issue right now with the banks, is that they're losing deposits, right? Because their savings deposits, their checking deposits are paying zero interest. And people could start moving their funds more easily right now to invest in treasuries, to invest. I think we talked about, you could go directly to the U.S. Treasury and buy bonds, right? You could buy the inflation-linked bonds directly from them. Link your checking account and purchase bonds directly. What's that website?
Treasury Direct.
Treasury Direct. You could do it through a brokerage firm. You open up a brokerage firm, and almost all brokerage firms at this point have a section for fixed income, and you could get a list of CDs. You could get a list of treasuries, so CDs that are FDIC insured. You could get a list of treasuries that are short term. You could lock it in for as little as a month or couple months. You don't have to go out 2 years, 10 years, and those are right now are paying pretty good yields that are the highest in like 10 years or even longer, right? I don't know, what are the 6-month treasuries paying? Close to 5%.
Close.
And that's going to be an issue for banks that are used to, carrying deposits, and paying zero interest, because if they're not raising the interest rates, people are going to start finding alternatives. And that's what that flow that is coming out of banks, it has to do with that, right? People want to chase yield at this point and say, I don't want to sit on 0% forever. And slowly they're taking their money and figuring out ways to either, purchase. And by the way, I went to the bank and their CDs are not as competitive as, like, if you go to your broker, open up your brokerage account, they'll give you CDs that are much more competitive. CD interest rates much more competitive, because some of these banks are still, offering CDs that are,
Yeah, well, if they offer them higher,
1%.
they're locking in a loss, right?
They're locking in a loss.
That's the duration risk, is they have all these long bonds.
Right.
And if they give a CD rate to stay competitive with the brokerage firms, they're going to be locking in, at least 1%, maybe higher loss.
Yeah. And if the yield curve stays the way it is right now, if we just continue like this for years, where the long end yield is much lower than the short-term yield, then the banking system has to start recalibrating, what is their business model, because usually they'll take the deposits and then, pay a certain interest rate and then go out on the longer end and earn a higher interest rate. And if that yield curve has changed, and if we're going to stay like this for a while, then, what is the banking system going to look like? How do they recalibrate their business model to account for that yield inversion, right? Because the banks can't pay 5% on their savings account and then invest it in long-term rates at 3%, right? They can't do that. They've gotten out of a lot of other riskier, riskier like business practices after 2008. So what do the banks look like? What is their business model? Are they going to just be holders of money and charge for transaction fees? So that'll be interesting. We'll hear from some of these banks. And by the way, at some point they're going to have to talk about the size of these banks. Some of the size of JP Morgan, Bank of America, Goldman Sachs. How long do you just allow this systemic risk to exist, right? Is it forever until something goes really bad, or do you get ahead of it? And we might have to have that debate and conversation, because if you look at JP Morgan and the size of JP Morgan, and if something goes wrong there, you got a huge systemic risk to our economy. Like JP, should we be in a situation where a single entity, like JP Morgan, can bring down the entire economy of a nation, or the world? If SVB Bank, we saw what was going on there, then JP Morgan is like a nuclear bomb. This here, Bank of America, Goldman Sachs, if we couldn't figure out the risk of SVB Bank, which is like not as complicated as JP Morgan, that has all these over-the-counter derivatives in this opaque market, this here is probably a huge problem. Nobody wants to touch, but that's a huge problem there, JP Morgan, because if for some reason the market senses that JP Morgan is a counterparty risk and people stop wanting to do business with them, then we're going to see a really bad economic downturn.
You're scaring me early on a Monday morning, D. I don't like this type of conversation.
If we're talking about banks, it should start going back to the the big too big to fail, right?
Yeah, and I mean,
You can't have
certainly
this
you look at
solution.
vols now. That seems like if that's on the table, they should be higher. But
If you look at yeah, you know, you've got a really bad, I don't even know how you save it. What are you going to do? The Federal Reserve is going to say we're just going to print as much money as possible. If that will also crash the economy. Because you got a really big bank here with so many different risks out there that nobody knows how to price. If they couldn't figure it out with SVB Bank, there's no way they know this risk. I don't care how many stress tests or shocks they do on JP Morgan. There's no way anybody could actually truly know the risks of this bank or Goldman or Bank of America. They're just too big, too many things going on, too many interconnections there, that even JP Morgan doesn't know, because they got contracts out there with other counterparties that they have no way of assessing. There's no way they could go into the businesses and read every financial, accounting statement and receipt and contract of all their business partners. It's not realistic. So this is maybe, the tension has to turn over to the too big to fail situation. Let me see, any questions yet? Well,
nothing's popped up.
okay. Let me see. We'll take a look just what's coming up in the earnings front. These are upcoming earnings, and I'm going to go to the next 2 weeks report. And we could see over here, let's say we kick it off on April 14th. JP Morgan will announce earnings before the market opens. But PNC Bank, BlackRock, Citigroup, Wells Fargo, Charles Schwab, that's been in the news. That's going to be on the 17th. They had a similar situation, invested in these long-term bonds. Those bonds, when interest rates go up, they lose value. They could hold them to maturity, but mark to market right now, they're sitting on unrealized losses. Okay? And that's the problem they're having. People are looking at it like SVB. And I think Charles Schwab, though, their customer base is a little bit different. It's not like venture capitalist firms that need to keep drawing on their savings. I wouldn't say they're exactly in that situation, but they did have a similar investment that they're sitting on unrealized losses in those U.S. treasuries, long-term U.S. treasuries. Bank of America also April 18th. So this is where it's going to start. Let's say around here, JP Morgan this week will kick off earnings season. And I think the tech sector is also, they're going to be watching, because what did the tech sector rally like 20% at this point?
So, I mean, some of them more, right? You look at Tesla, Facebook, they're really off, they're up almost 70 or 80% off their lows.
Some of them have really rallied. Netflix, some of those FANG stocks really rallied.
They have started to come in a bit. I mean, Tesla's, in a little bit. I think it was over 200 at one point. It's down maybe below 180 this morning. So they're off their highs.
Some of them are coming back down a little bit. Let me just take a look at SPY here for the year. Actually, let me come back to the summary. Here are the trading stats. So in the last 6 months, SPY up 10.5%. For the year, on a 1 year basis, down 6.9%. That's year over year. But year to date, just this first quarter, let's say, up 7.4%, which is a pretty good quarter, I would say, 7.4%, given that interest rates are are on the high end. And we had this issue in the banking sector, up 7.4%. The market, at least so far, looks pretty strong. And let me see here on the season. Let's do a month by month. So we're here right now in April, kind of unchanged, but this is, if we look at it month by month, January up 6.3%, February down 2.5%. So gave a little bit back, but then recovered that in March. In April, where we're like at around break even. And you could see, strong January. It was followed by a weak December, but a strong January. January tended to be one of the weaker months. Then February gave some back. So up over 7% so far in the first quarter. The market right now is moving in a direction that we would say is opposite of what, if we take the market as a forecaster, right? It's forecasting future earnings, future growth. And we took the bond market, which right now in the 10-year is pricing in that the Fed is going to cut rates because of a slowdown in economy. They are moving in the opposite. Right now, they're moving kind of in the opposite directions. So equity risk premiums, are low relative to historical bases, and the 10-year bond with the inverted yield curve is showing something different, that they think that the Fed's going to be forced to cut rates. And, as soon as this year, right, the rate cutting is going to start this year, which the Fed has said that they don't plan to do. So all this is right now going on. We don't know how it's going to get resolved. And I think that they're saying that the volatility right now in the fixed income relative to the equity markets is very high. Usually there's a correlation between the volatility going up in fixed income versus equity, but you could see equity markets volatility very subdued right now, even though we're seeing a lot of volatility going on in that fixed income market.
So there's certainly an opportunity to look for spots to hedge your overall stock market exposure if you don't want to just get out of stocks, right? I mean, there's
like, yeah, exactly. Strategies you can do to hedge off some of that stock market exposure with options. We talk by tomorrow's IBKR webinar will be on the option block trades, because I've been getting an accumulation of some questions. So that's what I'm going to be doing, is looking at the option block trades and doing some screens based on questions that I've been receiving in emails. So perfect. I guess, yeah, if there are no questions, well, I might just.
And I put a link to that webinar in the chat. I also put a link again to the doctor, Jake, wrote an article in Seeking Alpha, an earnings article, which is pretty interesting. He uses a lot of the Market Chameleon tools. So check those out. Great job, D, to start the week. No technical issues, which is always great. We got the show done. Thanks so much, buddy.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, chameleons. Everyone have a great day. Bye-bye.